What's going on, everyone? I hope you're having a great day. I'm Matt, and I'm back at it again with another technical analysis update. In this video, I'll be covering the NASDAQ 100, the Russell 2000, and the S&P 500 so you have a better idea of what to be watching for in the short term. Make sure you stick around until the end of the video because I'll be covering a seasonal trade I'm about to take. If you're interested in this type of content, subscribe to the channel and don't forget to turn on your notifications so you don't miss any of the timely updates. If you're interested in supporting this channel, it would be greatly appreciated if you could hit the like button and leave a comment. The engagement helps with getting this video in front of other people. But the best thing you could do is share this video with a friend. Alright, let's get started. Before I dive into the technical analysis, I want to bring your attention to two important economic announcements that will be taking place this week. On Monday, July 13th, the federal budget will be released at 2 p.m. On Thursday, July 16th, the jobless claims report will be released at 8:30 a.m. I'm not expecting a crazy market reaction to either of these announcements. I just thought it would be worthwhile to put on your radar. Let's start our technical analysis with the NASDAQ 100, which is tracked by the ETF QQQ. It doesn't take a stock market expert to realize that this tech-heavy index has been doing extremely well lately. Since its low in March, it's rallied over 54%. In the last week alone, it gained 3.34%. This close marks the second week in a row that the NASDAQ 100 has made a new high. If you've been fortunate enough to be invested in technology-based companies, there's a good chance you've been seeing a lot of green recently. In fact, this recent run has been so impressive that I'm personally going to take some of my profits off the table. Yes, it could continue to run, but this type of momentum is hard to sustain. On top of that, the recent high was divergent from an RSI perspective. When you compare the high from February to the recent high, you'll notice that even though we broke out to new levels, the RSI did not make a new high. This is considered to be bearish divergence, and it commonly means there'll be a reversion in price, but it doesn't mean it has to happen right away. From a weekly perspective, I would not recommend taking a long position now. In reality, I wouldn't even recommend shorting this market right now because it's not close to an area of support or resistance. From a technical analysis perspective, it's difficult to call out areas of resistance because the chart hasn't developed in this region. Hopefully, as more time passes, we'll have a better idea of where the demand truly lies. On the flip side, we do have a better idea of some key support levels. The first one would be this top trend line. If the bulls can't defend this area, I would then be watching for support from last week's low at 237, which aligns with the high in February. If the bears push the market below that, I would then be watching for 231, which served as support for 3 separate weeks. In terms of percentage movement, the trend line would be a decline of roughly 4%, the first support would be 10%, and the second support would be 12%. That's the current structure for the NASDAQ 100 on the weekly time frame. Let's go to the daily time frame to get a more granular view. As you can see, we have 2 separate bear flags. These do commonly break downward, but not always. The market did close above this top trend line, but not by much. If this can hold, I would expect positive momentum to continue. But if the market is rejected, I would be watching for a bounce off of this middle trend line, followed by a bounce off of the previous high at 251. And depending on if and when this plays out, this bottom trend line could always serve as support. If this bear flag is broken, my first target would be 237, but I don't think this will be happening in the near future. The first horizontal support would be a decline of just under 5%, and the second one would be around 10%. These are the daily timeframe levels you should be watching on the Qs. But now let's switch gears to the Russell 2000. This is the weekly chart for the Russell 2000, and as you could tell, it's nowhere nearly as bullish as the NASDAQ 100. It has been able to rally 39% since its low in March. That's definitely a bullish move, but keep in mind that it's roughly 23% away from making a new all-time high. 145 has proven to be an area of high contention. Since mid-May, it has served as resistance, and on multiple occasions last year, it served as support. If the bulls can push the market above this line, I would then be watching for 153. Above that would then set up 158. This first resistance line would be a gain of just under 3%, the second one would be 8.5%, and the third one would be over 12%. On the other hand, let's take a look at what happens if the bears show strength and push the market down. There is a lot of support in between 137 and 133. A push below this region would set up 117, and if the bulls can't protect this line, then the previous low of 95 would be in play. Since we are on the weekly chart, these would be longer term bearish targets, but the first line would be a decline of 17%, and the second one would be over 32%. To get a better idea of what might happen in the short term, here's the daily chart. There now have been 2 closes below this bottom trend line. If the bulls cannot recapture it, I would be watching for 136. This recently served as support and was previously resistance in April. The next target would be 133, which has the similar pattern of previous resistance turning into support. If the bears show a lot of strength, you could then be watching for this gap fill. If the bulls do recapture this trend line, that would set up 145, which could lead to a test of this upper trend line. And above that, we would then be watching for 153, which was the previous high from June. These 3 lines of resistance would be a gain of 2.8%, 4.8%, and finally 8.5%. The 3 regions of support would be a decline of 3.4%, 5.6%, and roughly 10%. Overall, the Russell 2000 has proven to be weaker than the Nasdaq 100. But let's check out the S&P 500, which is in between the two. Here's the weekly chart for the SPY, and as you can tell, we're getting very close to this trend line. If the bulls can push the market above that and hold, that would then set up 323. If the bears lose this fight, I would then be watching for this gap fill. If there's enough demand here, that would set up a test of the all-time high at 339. The first target would be a gain of 1.8%. The gap fill would be a gain of 4.6%, and the all-time high is 6.7% away. But if the market is rejected at this trend line, that would set up the key psychological level of 300. If the market continues to fall from here, I would then be watching for 276. There is also proven support at 271. This first line of support would be a decline of 5.6%, the second one would be 13%, and the third one would be 14.5%. To know what to look for in the short term, here's the daily chart for the SPY. This top trend line is the same one we saw on the weekly chart. But now we can better understand that the market has been consolidating in this primary wedge structure. Periods of consolidation are followed by periods of expansion. Once we get out of this wedge, I'm expecting a large move. If we break upward, the next resistance would be at 323, and above that would be a test of the all-time highs from February. If the market is rejected at the upper edge of this wedge, there is support at 310. Below that, there's a lot of demand between 308 and 306. If this wedge structure is cracked and the market breaks downward, the first support would be 298. For those of you keeping track, this first bullish target would be a gain of just under 1.8%. The bears will be looking for a decline just over 3% and just under 6%. There is a slightly different story developing in the S&P 500 futures market. It has a similar primary wedge structure, but there is no second wedge. Above this top line, the bulls would be looking for 3,227. But if the market is smacked down here, that would set up 3,080, which would align with this bottom trend line. If the bottom trend line and this support is given up, the bears would be looking for 2,983, then 2,923. This is very similar to the S&P 500 ETF SPY. I just wanted to point out the subtle differences. As always, for all 3 of these indices, don't forget to lose track of the VIX. Typically, as volatility increases, the overall market will decrease. But if volatility dies out, there's a good chance that the overall markets will continue their journey upwards. Overall, these are the main areas of support and resistance I will be watching in the markets this upcoming week. In the short term, I am bullish, and that's because of a seasonal pattern I will now show you how you could potentially profit off of. The video on the top of the screen now and in the description below fully describe all details of this trading strategy. To quickly summarize it, there's a seasonal advantage to buying into the S&P 500 on the 8th trading day of July. For example, in the year 2019, the 8th trading day of July was on the 11th. This strategy took a long position when the market opened at 2,978.75. Then, because the close was profitable, an exit was triggered at the next open at 2,985.75. This gain of 7 points on the futures market was a profit of $350. Last year was an obvious success, but here are the results for the past 2 decades. Since it trades once per year, there was a total of 20 trades. 18 were profitable, 2 were not, so the accuracy was 90%. The gross profit was just over $11,000 and the gross loss was $112. This means the profit factor was 101.22. In other words, for every dollar lost, over 100 was gained. This total net profit is based on a trading lot size of 1 futures contract. You could obviously choose to scale these results up by using more contracts, or you could scale them down by using micro contracts. The futures market does have different trading hours than the normal US market. Because of that, I thought it would be important to show you how the exact same strategy performs on the SPY. As you can see, the strategy took a long position on July 11th of last year. Similar to the futures market, it exited after a profitable close. When applied to this market, the accuracy is still 90%. When you consider the gross profit and the gross loss, the profit factor is 3.57. The total net profit is based on a lot size of 100 shares, which would also be equivalent to 1 option contract. For those of you interested in the robustness of this strategy across various markets, here are the results of the Nasdaq 100 futures contract. Even though the profit factor was better on the S&P 500, the accuracy was increased in this market. Additionally, here are the results for the same strategy when applied to the Russell 2000 futures market. As you can see, the results are very similar to the SPY ETF. Personally, I will be looking to take advantage of this seasonal pattern when the S&P 500 futures market opens on the evening of July 12th. It's not too often that traders call out their trades before they happen. I will happily keep you updated to how it plays out. If you enjoyed the video, let me know by hitting the like button. If you enjoyed this type of content, subscribe to the channel and don't forget to turn on your notifications. Thanks for watching, and as always, best of luck in the markets.